At 2 this afternoon, Federal Reserve Chairman Jerome Powell announced a 50 basis point interest rate increase, the most aggressive single hike in 22 years. Within 90 minutes, $1.2 trillion in market value evaporated. At 3:47 p.m., the president demanded Powell's immediate resignation. At 4:15 p.m., Powell refused. At 6:34 p.m., the White House began reviewing emergency executive authority to override Federal Reserve decisions. Subscribe immediately, because this is not routine policy disagreement. This is the Federal Reserve versus the executive branch in a confrontation that has never occurred in the 111-year history of the Fed. The next 72 hours will determine whether the central bank can function independently or whether presidential pressure can override monetary policy. At 2 p.m., the FOMC voted 11-1 to raise rates by 50 basis points to 5.25%, 5.50%. Powell cited three factors: core inflation at 4.1%, unemployment at 3.7%, and continued consumer spending pressure. The critical section addressed political pressure directly. Quote, "The Federal Reserve makes monetary policy decisions based on economic data and statutory mandates. These decisions are not influenced by political considerations or executive branch preferences. Central bank independence, established by Congress in 1913, is essential to maintaining price stability." This responded to pressure that began 72 hours ago. On Monday at 11:23 a.m., the president posted, "I am ordering the Fed to hold rates steady. The American people elected me to protect their economic interests, not to let unelected bureaucrats destroy prosperity." At 2:47 p.m., Powell responded, "The Federal Reserve does not take orders from the executive branch." Hit that like button right now. The Fed just raised rates despite presidential orders. The algorithm decides what breaks through. You decide whether this reaches people who need to see it. At 2:47 p.m., markets collapsed. S&P 500 dropped 6.2%. Dow fell 1,847 points. NASDAQ declined 8.1%. By 3:30 p.m., total losses reached $1.2 trillion, the largest single-day decline since March 2020. Trading volume exceeded 18 billion shares, double the 30-day average. The sell-off hit every sector. Financials dropped 7.8% on recession fears. Technology fell 9.2% as higher rates pressure valuations. Real estate plunged 8.4% on mortgage rate concerns. Only energy and utilities showed resilience, declining less than 3%. Bond markets saw violent moves, with 10-year Treasury yields spiking to 4.87%, the highest since 2007. At 3:15 p.m., Goldman Sachs chief economist issued a note to clients. The rate hike itself is defensible on inflation data. The political confrontation is not priced in. If the president succeeds in removing Powell, Fed credibility collapses and inflation expectations will surge. By 3:30 p.m., J.P. Morgan upgraded recession probability from 35% to 55%. At 3:47 p.m., the president posted, "Jerome Powell has destroyed $1.2 trillion in American wealth. He ignored my direct instruction. I am calling for his immediate resignation. If he does not resign by close of business, I will take action to protect the American people." At 4:15 p.m., Powell held a press conference. Asked about the resignation demand, Powell responded, "I was appointed to a 4-year term running through May 2026. Fed governors can only be removed for cause: inefficiency, neglect of duty, or malfeasance. Making a monetary policy decision based on data and statutory mandates is none of those things. I will not resign." A reporter asked if he consulted legal counsel about potential removal. Powell stated, "The Federal Reserve has clear statutory protections. The Supreme Court affirmed in Humphrey's Executor that independent agency heads cannot be removed at will. That precedent is 90 years old and has never been overturned." Asked if he fears removal, Powell stated, "The Federal Reserve Act establishes central bank independence. President Johnson pressured Chairman Martin in the 1960s. Martin refused. President Nixon pressured Chairman Burns in the 1970s. Burns complied, contributing to that decade's inflation crisis. The lesson: independence is not a luxury, it is necessity." Drop a comment. Should a president override Federal Reserve decisions during economic crises? 67 million Americans with 401ks and mortgages are asking this right now. At 6:34 p.m., White House sources confirmed emergency meetings on three options. Option 1, invoke the International Emergency Economic Powers Act, arguing Powell's decision constitutes economic emergency. Legal scholars call this unprecedented and likely unlawful. The statute was designed for foreign threats like freezing Iranian assets, not overriding domestic central bank decisions. But White House counsel is examining whether the $1.2 trillion market loss qualifies as unusual and extraordinary threat. Option 2, issue executive order declaring national economic emergency with direct presidential oversight of Fed decisions. No precedent exists. This would trigger immediate court challenge. Federal Reserve Act specifically protects governors from removal except for cause. White House lawyers acknowledge this is weakest option legally but strongest politically. Option 3, use Treasury Secretary's FOMC position to create pressure for reversal. Treasury participates in meetings but doesn't vote. Secretary could demand emergency FOMC session to reconsider. If 3 governors flip, reversal becomes possible. At 7:12 p.m., Treasury Secretary released a statement. I respect Fed independence. However, I have serious concerns about timing and magnitude of today's increase. The economy shows signs of moderating inflation. Aggressive hikes risk unnecessary recession. I have communicated these concerns to Chairman Powell. Subscribe now because what follows is market, congressional, and international reaction to this standoff. At 7:45 p.m., S&P 500 futures dropped another 1.8%. Gold surged $67 to $2,244. Bitcoin jumped 11% to $30,400. VIX reached 41.2, highest since October 2020. At 8:17 p.m., Senate Banking Chairman Sherrod Brown, the Fed must operate without political interference. Chairman Powell acted within authority. Congress established independence to insulate policy from political pressures. I call on the president to respect that. At 8:34 p.m., Senator Tim Scott, while I support independence, Powell's aggressive decision, despite economic warning signs, raises questions. Congress should hold hearings. At 8:41 p.m., Senator Elizabeth Warren, typically a Powell critic, issued unexpected support. I have disagreed with Chairman Powell on many issues, but the independence of the Federal Reserve is sacrosanct. No president can fire a Fed chair for making a policy decision. This is a constitutional line that cannot be crossed. At 8:52 p.m., House Speaker Kevin McCarthy, the House will monitor the situation closely. If the president takes action to protect American families from reckless Fed policy, we will support appropriate measures. That signals potential House Republican backing for executive action. At 9:02 p.m., ECB President Christine Lagarde in Frankfurt, central bank independence is a cornerstone of monetary policy frameworks. Political pressure creates uncertainty, undermines credibility, and makes inflation control more difficult. We are watching the United States with concern. At 9:23 p.m., Bank of England Governor Andrew Bailey issued a statement. The independence of central banks from political interference is fundamental to effective monetary policy. Markets require confidence that policy decisions are based on economic analysis, not political expediency. At 9:47 p.m., former Fed Chair Ben Bernanke in WSJ, in 2010, I faced intense criticism. President Obama defended Fed independence. Today, we see the opposite. A president demands resignation for a policy decision he dislikes. If this precedent takes hold, the Fed's ability to control inflation will be permanently compromised. Here are 6 indicators being watched over 72 hours. Indicator 1, does the president file emergency executive orders? If yes, within 48 hours, constitutional crisis. If he backs down or remains silent past Thursday, Fed independence reaffirmed. Indicator 2, do Fed governors break with Powell? The FOMC has 12 voting members. If 3 or more issue dissenting statements by Thursday, Powell's position weakens significantly. If they rally, he strengthens. Indicator 3, market response Wednesday. If S&P drops another 3% or more, pressure intensifies. If losses hold at 6% or markets recover 2%, suggests investors support the decision despite political noise. Indicator 4, congressional action. If Banking Committee schedules emergency hearings by Thursday, signals institutional support for president. Silence or statements defending Powell maintain Fed position. Indicator 5, do major institutions back Powell? Watch for statements from former Treasury Secretaries Yellen, Mnuchin, Geithner. If 2 or more defend Powell by Wednesday evening, provides crucial political cover. Indicator 6, does the president escalate or pivot? Daily attacks through Friday create sustained pressure campaign. If president focuses on other issues by Thursday, immediate crisis de-escalates. Here are 3 scenarios. Scenario 1, the president backs down. Advisors convince him emergency powers would fail in court and damage markets further. Within 24 hours, the president shifts focus to other issues. By 48 hours, he stops mentioning Powell. Markets stabilize as investors interpret silence as de-escalation. Powell remains through his term. Precedent set. Presidents cannot remove Fed chairs for policy disagreements. This is independence reaffirmed. By Friday, S&P recovers 4% of losses. Within 2 weeks, the crisis becomes a historical footnote. Scenario 2, legal stalemate. The president issues executive order asserting authority over Fed decisions. Powell refuses. District judge blocks enforcement within 36 hours. Case moves to appellate courts and potentially Supreme Court. Litigation takes months. Uncertainty paralyzes markets. The Fed continues making policy, but investors question whether decisions will be overridden. VX remains elevated above 35 for weeks. This is prolonged institutional conflict where neither wins cleanly. The uncertainty itself becomes the crisis. Scenario 3, Powell resigns or is removed. Facing sustained pressure and market chaos blamed on institutional standoff, Powell concludes his position is untenable within 72 hours. Or the president finds legal mechanism to remove him. New Fed chair signals rate cuts within first week. Markets rally initially. S&P up 3% on day one. Long-term investors question whether Fed can credibly commit to fighting inflation if chairs can be removed for unpopular decisions. Inflation expectations rise. This is independence destroyed with severe consequences for monetary policy credibility. Subscribe now, like this video, comment with scenario prediction. All three are being tracked. Historical context, presidents have always had Fed opinions. Truman disagreed in the 1950s. Johnson pressured Martin in the 1960s. Nixon pressured Burns in the 1970s. And Burns's compliance produced the worst inflation crisis since World War II. The lesson from that era is clear. When presidents control monetary policy, inflation spirals. Trump criticized Powell frequently 2018 to 2020, calling him enemy and demanding rate cuts. But Trump never demanded resignation after a specific policy decision or threatened emergency powers. The closest parallel is 1971 when Nixon pressured Burns to keep rates low before the election. Burns complied. Inflation hit 12% by 1974. That experience taught economists that central bank independence is not abstract principle, but practical necessity. When political pressure overrides economic judgment, the consequences are measured in decades of damage. No president has ever demanded Fed chair resignation immediately after a policy decision and threatened emergency action to override it. What is happening now is categorically different. What is certain, at 2:00 p.m., Fed raised rates 50 basis points. By 3:30 p.m., markets lost $1.2 trillion. At 3:47 p.m., President demanded Powell's resignation. At 4:15 p.m., Powell refused. At 6:34 p.m., White House explored emergency authorities. At 9:02 p.m., ECB criticized the pressure. At 9:47 p.m., former Fed chair warned, this threatens institutional credibility. This is Fed independence being tested at unprecedented levels. If Powell survives without compromising, precedent strengthens future chairs. If forced out or forced to reverse, every future chair will know presidential pressure can override independence. The stakes extend beyond Powell. Every Treasury auction, every dollar transaction, every international investment in U.S. assets depends on confidence that American institutions function according to rules, not presidential preference. If the president can fire a Fed chair for a rate decision, why would foreign central banks hold dollars? Why would bond markets trust Fed inflation commitments? Why would any investor believe American monetary policy serves economic stability rather than political expedience? The next 72 hours answer whether the United States still has an independent central bank or whether the Fed has become another executive agency serving at presidential pleasure. That answer will echo through financial markets for decades. Stay with this channel, turn on notifications. When the White House announces next moves, when markets open Wednesday, when Powell responds, analysis will be here immediately. This is the Fed defending statutory independence while a president threatens emergency powers to override monetary policy. One position will prevail, and which one determines whether central bank independence survived 2026.